Hey everybody, welcome to my video on the loanable funds market, part 1. If you've watched some of my other videos, you know I already made some of these for an intermediate macro class. Well, this one is for a principles level class. So there's not going to be much math, it's just going to be graphs. We're going to get some good intuition here. So what is a loanable funds market? First, let's talk about what are loanable funds. Funds being like money and stuff, and loanable meaning borrowing and lending. So there's a market for money and how much money we're going to lend. Let's talk about the participants in this market because it's kind of hard for some people to think about. So the product is money, loanable money. And so the Q, I could write Q here. I'm just going to call it dollars, whichever way you want to put it. It could be different kind of money, whatever. And then our price, I'll show in a minute, is going to be your interest rate. That's the price on a loan, right? When you take a loan out to buy a car or a house, you have to pay back with interest. That interest is the price of that money. When you give out a loan, you're selling loanable funds, and the price is the interest. So this is the market in a nutshell. And like any market, there's going to be a supply curve and a demand curve. Let's talk about these two different sides. The supply curve. And like any functioning market, there is a supply curve and there is a demand curve. So let's talk about these two separately real quick and figure out what their incentives are. Demanders, who are they? These are the people who want to buy loanable funds. These are borrowers. These are people who want to use your money today, and they're willing to pay you interest to do so. And these borrowers, if they're behaving rationally, are doing it because they expect whatever they're spending their money on to give them a good enough return to pay back with interest. And because of this, we will usually attribute investing to them. Now, I don't mean investment like, hey, on the stock market. I'm talking about like investing, like I borrow money to start up a business, or I borrow money to build a house. We're talking like econ investing, building capital and stuff. The borrowers are the people who do the investing. They bring funds together by borrowing in this market, and then they will use those funds to build their projects. These are the people willing to pay interest to get money now. Now, these suppliers, where does the money come from? The suppliers come from people who have extra money laying around. These are savers. They've saved extra money, enough that they're willing to lend money out for a price. People with savings are the supply curve for loanable funds. And what are they going to do? Instead of investing, they're going to lend. The suppliers are lenders. These are the ones who give the funds out in the market. And where does their money come from? Well, it comes from the fact that they've saved it up. The savers in the market have extra money, and they're willing to let borrowers use it if it will give them a good return. There's your players in the market. There's their incentives. Savers have extra money. You can use it today if you pay me back with interest. Investors need money today to build their projects and get their capital, and they will pay back with interest once their capital is up and running. Beyond that, it's basically just a market. There's an equilibrium quantity. There's an equilibrium price. One thing to point at this equilibrium quantity, investment based on your demand curve is equal to savings based on your supply curve. Savings equals investment. That's a big equilibrium result in this market. If your market's not in equilibrium, it doesn't have to be true, but then market forces will generally equilibrate it eventually. So I know that was kind of brief, but I guess it's a good enough start. I hope it's helpful. Check out part 2, and we will talk about what happens when the government decides to borrow a bunch of money and what that might do to private investment. Thanks for watching, guys. Good luck.